This is TreppWire Week in Review for week ending June 24th, 2022. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Hendry, Head of CRE and Advisory Services. This week, in testimony to Congress, Fed Chair Powell said that the central bank is committed to bringing down inflation, but a recession may be hard to avoid. And President Biden asked lawmakers to suspend the federal gas tax. In economic data, existing home sales fell in May as anemic supply helps drive the median price to a new high, and manufacturing lost momentum in June. Manus, today stocks ended up and treasuries rallied. What are we looking at, a short-term bounce?
Well, it certainly was a less volatile week this week than it was last week. It's funny. I was trying to come up with a metaphor for what these last 10 days have felt like. And I started thinking about college football when I was growing up. There was a great program. It's not so great anymore, but it was in the 70s, Southern Cal with John McKay. And their big play used to be student body left or student body right, which was just pitch the ball to the running back and everybody on the field runs either left or right, aiming for somebody on the defense. And it gave the perception that the entire campus student body was running at the defense. And they had great running backs back then, Ricky Bell and Charles White, Anthony Davis. And it made me think, and why did this metaphor come up? It's because everybody seemed to be buying into one argument for 3 days, and then they pivoted to a second argument, and the entire marketplace moved to this other narrative. And then they moved to a third one this week, and each time came kind of a different market reaction. So 10 days ago, before CPI, we have already seen peak inflation. Markets were rallying. Inflation will now start to come down by its own weight. People will start consuming less, and this will lead to a soft bounce, right? Maybe no recession at all. And the markets were rallying during that time. And that's what 90% of the people seem to believe. And then we get CPI, and then the entire student body of market researchers moves to the sideline of inflation will never go away. We're going to 20%, and this is going to lead to a crushing collapse. And then without any really new data out there, this week, the narrative was inflation is not the concern. It is the hard landing. The Fed is already going to squeeze us so hard on interest rates that, the big concern right now is the economy grinding to a halt. And the truth is, at least I can't claim to be the arbiter of the truth. It's only what I think will come down the road. I'd like to be the arbiter of the truth. The truth is somewhere right down the middle, right? Which is interest rates will take a bite out of earnings. Higher costs will take a bite out of earnings. Companies will, and Martha will talk about this later, hire less or lay people off more to offset this compressing margin. And that will lead to pain, right? On the commercial real estate side, it will lead to episodic pain in terms of falling valuations and or buyer remorse. Why did I buy this thing at a 3 cap rate when I knew the market was getting frothy? Do I think any of this leads to the kind of gloom and doom we had 7 days ago when inflation was going to 20%? No, I think what we're going to go through is what we see periodically and what people used to think of as the once every 5 to 8 year recession. And it'll be painful for some. People will lose their jobs. And that's hard, right? I don't want to dismiss the fact that for certain people, that's incredibly painful. And for people at the low end of the economic spectrum, higher food prices is a real issue. But I think it's neither peak inflation and risk on all over again, nor is it the end of the world recession is coming. And I think that the sooner we get away from this bipolar nature of the research community and market watchers, the better off we'll be.
Yeah, I think unfortunately, man, it's like that's just kind of where we are with society right now. Like things either are one way or they're completely perceived as being the opposite. And there really isn't too much in the middle anymore. And so, Jerome Powell this week was giving, his testimony, and a couple of things that I took away from that he basically hedged a little and said the chances of a soft landing at this point are going to be perceived as very challenging, and that officials anticipate ongoing rate increases will be appropriate. So it's interesting. He combats that by saying general economic conditions are favorable, strong labor market, high demand. So kind of hedging where we're at and where they're going to go. A couple of other just kind of market bullet points. Citigroup's Economic U.S. Surprise Index gauge of whether economic data beats or falls short of analyst expectations. So kind of tying it back to your research and analyst commentary there. It's fallen to the lowest level since May of 2020 and has been in negative territory for over a month. Index plummeted to a reading of negative 13 from nearly 70 a month ago. So indicators have recently been disappointing. Another study actually showed that the index, referred to as CESI, correlates to Treasury yield moves. And then we mentioned the last couple of pods around mortgage application and home sales, and Martha teased it in the lead-in. Home sales actually declined again, and I don't think there's going to be any slow up in that. I mean, I've seen just anecdotally in my business, we've seen a lot of homes being listed with price reductions over the last 6 weeks, which we haven't seen in over 2 years, and it's fairly noticeable in the industry. No more lines around open houses when they get listed. Things are actually taking more realistic time frame to sell. Some potentially good news here, though, is according to MBA, mortgage applications to purchase a home were up last week. So they were up 8% compared to the previous week, partially in demand, bolstered by demand for adjustable rate mortgages. One other takeaway there was just the fall off on the refinance side. So obviously refinance applications fell 3% for the week and were 77% lower than the same week a year ago. So, I think potentially some tepid good news on mortgage applications, even though sales slowed down. And the refinance market has pretty much fallen off a cliff. We've seen that now for the last couple of weeks.
Yeah, so I was talking to somebody in the construction business. He works in a regional operation down south, and I happened to speak to him today, and I speak to him periodically. And I asked, what does it look like now? What does your business look like now? And he said on the selling side, on the new home side, people are at a point now where they can't afford it, right? When they went from a 3% rate to a 6% rate, that was enough for them to say, we're now priced out, right? So he has seen a slowing of demand on his side, but he said the green or the silver lining, if you will, is that he's finally seeing a little bit of reduction in the cost side of things. The lumber, the windows, the glue to put the windows in, everything that comes with it. He says it's nowhere near to pre-pandemic levels, but he's starting to see a little bit of relief there. So that was just one person's observations. But going back to Martha's original question, what was this week? Is this a momentary bounce? Is this a bear market bounce? Or is this the beginning of us coming out of things? I don't think even though I'm optimistic, and I don't think this is apocalypse now for either the broader economy or for commercial real estate, I do think that there's more pain on the way. On the equity markets, I think we have a combination of slowing sales, slower revenue, right? The consumer is pinched. And on the supply chain / cost side and wages, we see, higher expenses, right? So between the two, that is going to narrow margins, and that will probably lead to a lowering of earnings expectations for the rest of the year, right? Which is not a good thing for the stock market. And you could take that same position for most of the commercial real estate market, right? You get squeezed at the top end, you get squeezed at the bottom end, lower margins, right? Lower debt service coverage ratio, which leads to lower values. But I think to capture the headline we used in the podcast, come on, 2 weeks ago, apocalypse not is my position.
So let's start digging into the property sectors. We're going to start with retail, and we are going to start with some green shoots.
Yeah, it was a week of a lot of impressive sales, both in terms of the distribution of the sales types, the prices people were getting for these assets, and the geographic diversity we saw. I'll run through some of them a little quickly. The most impressive one to me was in Pasadena. The retail shops at record sold for an all-time high of $1,800 a square foot. This particular property has a Tiffany, Crate and Barrel, and a Foot Locker. It sold for $52.3 million. It's only a 28,000 square foot property, but it went for a fortune. Why did I lead off with this one? Primarily because what we've seen in California, the negative press that we've seen, and some of our friends out there have told us recently, it's not as bad as the media would have you believe. We got some emails this week, but we've seen the videos of the smash and grab and the break-ins at high-end retailers. And this story captured my attention because you have a Tiffany property being sold for a record price. And so here you have a situation with a buyer coming in, and the buyer was Blatte and Schnorr, ponying up more than $50 million for this particular asset, kind of a vote of confidence for the high-end retail segment there. I know, that's kind of Lonnie's sweet spot, the Tiffany, high-end retail is his kind of thing. So Lonnie, what do you think about that?
Yeah, well, first of all, I'm more of you and I are aligned on the Kohl's, man. It's like we've talked about this. Like I'm more of the tweed jacket from Kohl's type, but I've driven past Tiffany's a few times, never gone in one. So, but yeah, it's interesting. It seems like, we talked a lot on the pod about the bifurcation of the office market with the Class A's, doing well, and the B's and C's maybe not as much. And I think we're starting to see some of that in the retail space, where some of these, really recognized credit tenant centers are, selling for increasingly higher prices. And I think it maybe speaks to the fact that as the markets become more and more uncertain, they're at least tying some certainty to the credit ratings or the long-term leases that are generally in place with those, more national tenants. So good sale, crazy high price per square foot, but not surprising given some of the other high-end retail sales that we've seen over the last couple of months.
Lonnie owning up to an affinity for the cubic zirconium market, from what I gather. Some other sales we saw, a distribution here that I'll talk about. Kiawah Island, which is kind of really upscale, South Carolina. Freshfields Village there sold for almost $125 million. Harris Teeter anchored, that's grocery store. In New Orleans, the Outlet Collection at Riverwalk sold for $34 million. That caught my attention primarily because outlet centers have been kind of a mixed bag, right? We've seen some really lose a considerable number of their tenants. Their tenants never amount to an awful lot of their square footage. A lot of their top tenants only make up 5% of their square footage, or 4% or 3%, but we have seen some bumpiness. But here we saw an outlet center in New Orleans trade hands. And in San Leandro, California, the Bayfair Center sold. And here the buyers ponied up $57 million with the idea that they're going to take some of that mall, raise it, and put in multifamily housing. So normally when you see that kind of story, you're thinking about things going for 10 or $20 million, right? The cost of acquiring is X. The cost of tearing down is Y. Before you know it, those numbers really start to add up, and then you have to develop. Here, that's a real premium price, and we've seen it elsewhere, right? We've seen it with that facility that was bought by the Rams owner. Periodically, you see parcels that they're in such high desirable locations that they do get that premium price. So 3 or 4 nice green shoots for the retail market this week.
Yeah, I was going to throw one out there too, man. It's on the Nordstrom Rack. I don't know if you guys saw this or not, but Nordstrom Rack is back. So I want to throw a shout out to one of our coworkers, Tom C. He has been known to frequent the Nordstrom Rack and come into the office with some really dapper clothing. And so this actually will help him because the CEO, Eric Nordstrom, said during an advisory group fireside chat on Tuesday that they're going to lean into their brick and mortar expansion at the off-price, banner store. They're more dependent on physical locations going forward for the Nordstrom Rack. They had taken some steps over the last few years to actually increase their Nordstrom Rack footprint and then they decided to hit the brakes. But it looks like they've conducted some internal research that shows off-price shoppers, which those off prices are still pretty high for my budget, aren't likely to drive more than 15 or 20 minutes to access a rack store. So they really, they took that information and said they're going to expand their footprint and add some additional brick and mortar Nordstrom rack stores. So for Tom C, hopefully they'll put one in close to your new place, and you can continue the nice dapper clothing at the office.
We have mentioned this endlessly over the last year, where that part of the market has just done really well. And I guess it's no real surprise that Nordstrom will double down on kind of their discount version of their chain, because we have seen Burlington and Marshalls and Kohl's and others just really do well. I did leave out one big story. I don't think I mentioned it last week. In Cary, North Carolina, this is a story from Cliff Barnes of the Triangle Business Journal. Heinz is buying the Waverly Place property, which houses a Whole Foods as its anchor, paying $88.5 million. That's up from $52 million in 2014. So more than a 50% gain in value in that Cary, North Carolina property. And while I'm at it, a couple of other things here, just before I forget, that green shoot before from Tiffany in Pasadena, that was Greg Cornfield of the Commercial Observer. So just a lot of good things going on in the retail market, and really great to see it.
So let's pivot to office, and we do have a number of green shoots, but before we get to those, there were a number of stories this week on layoffs and rescinded offers from a number of companies. You've been watching the tech companies reporting layoffs over the last few months. A company that tracks that called TreppWire, they said that that's affected about 48,000 people so far this year at about 95 companies. But then you saw JP Morgan, Netflix, we saw a furniture company in Mississippi, a logistics company in Texas, and an auto manufacturing plant in Michigan all announced layoffs in just this last week alone.
Just as with, the beginning of COVID and the crackdown on business travel, right? We saw the revenge of the CFO, right? For decades, the CFO had just seen expenses spiral higher and higher and higher on business travel, on lodging, on meals, on entertainment, on conferences, and that COVID time gave the CFO the opportunity to bring everything back to something that was more in line probably with the expense that was desirable. And I think that what we're going to see in the forthcoming years is that same opportunity be taken, right? As we see revenue decline, as we see expenses go up, companies are not going to take this lying down, and they're going to use this as an opportunity to right size their companies in an effort to protect that margin. And I think that over the next 12 to 18 months, we'll see more of this, right? In the past couple of years, it's been much more, this bank is hiring 300 new employees this year, and this bank is hiring 400, and this tech firm is hiring 500. I think that there'll be extraordinarily higher levels of discipline when it comes to hiring that will be driven by compressed margins. I think that this will be a recurring theme throughout the remainder of 2022 and the first half of 2023.
Yeah, I think there's a tie in here too, man. It's just to the economic conditions we talked about in the lead in. This is the shoe that I'm going to be keeping an eye on. If we start seeing layoffs more widespread, if we start seeing them with more magnitude in terms of volume and numbers, I think that really will accelerate some of the recession and other type of, pain that's going to be felt. Because while consumer sentiment has been down, and we've talked about the Michigan study and some other things over the last couple of weeks, people have still generally been spending money and, not necessarily cutting back significantly. But when people start losing their jobs, if you're in a 2-income house and you go to 1, a lot of things change very quickly. If you're a sole income provider and you lose your job, that's pretty devastating. So I think, this is something, I'm glad Martha brought this to the pod today, because I do think this is something we have to keep an eye on, because this could be very indicative of kind of how quickly or how deeply the recession, if we get to that point, actually turns out to be.
I mean, sentiment is everything, isn't it? That for the last couple of years, the job market has been so tight that employees have felt like I can leave tomorrow and get a 20% bump. And that leads to an awful lot of confidence in terms of spending money. And we talk about the wealth effect, right? We talk about it from the individual, right? If your stock portfolio is down 20%, right? You start to tighten your belt a little bit. With companies, if your margin is down, you start to tighten your belt. And it doesn't take layoffs necessarily to have people change their perception of what they can spend. If that tech guy thinks, well, I'm going to have to stay here for a while, that 20% pay hike is not right around the corner anymore, it doesn't take a big retrenchment in the job market to change spending patterns, right? So we don't have to see unemployment go from 3.6, which is around where it is now, to 5. We just have to see those job listings go down for people to start to say, you know what, I'm not going to go out and take that 5-star vacation this year. I'm going to, do the staycation or something else. So it is something to watch, and I'm glad, as you said, Lonnie, that Martha brought it up and you emphasized it, because I do think it's something that could overcome the economy very quickly.
So let's get to the green shoots. We've got a few to cover.
Yeah, we got so much in office again this week. It just seems like every week office seems to be the dominating theme here. We'll run through them as quickly as we can. In Camden, this comes from the Philadelphia Business Journal. We go back a long way with Natalie Castelny. She covers Philadelphia and South Jersey extremely well and has for years. Camden County there has signed an 11-year lease for $150K at the Woodcrest Corporate Center in Cherry Hill, New Jersey. That brings that particular property back up to 100% occupancy. In downtown Chicago, a story I love is downtown Chicago has really been battered for the last couple of years. Abbott Laboratories is opening a new office at the Willis Tower. It will occupy 100,000 square feet over 2 floors, run enough room for 450 new jobs at that location. In New Orleans, law firm Jones Walker has renewed at Place St. Charles. The firm has over 250,000 employees. They occupy 151,000 square feet at the Class A property at 201 St. Charles Avenue in the CBD in that city. That's from the New Orleans Business Journal. Why do I love that story? Jones Walker not sacrificing any space that they're renewing for the entirety of the space. In Manhattan's Hudson Yards, Brookfield Properties signed Clifford Chance to 150K. They're going to occupy 4 stories at the 1.9 million square foot 2 Manhattan West, which is under development. 2 others, again, it's just endless green shoots. Takeda, the pharmaceutical firm, is going to take almost 700K in Cambridge, Mass. And Bain in Boston taking 100,000 square feet as it moves to the Seaport area. So just a lot of good stories there. So these green shoots kind of tie back to my original thought of apocalypse not for offices, right? And I want to get Martha and Lonnie to weigh in on this. And maybe this will get a little bit dense. Maybe I should have saved this for next week, but let's see. There are 5 pillars that make up commercial real estate, right? You have interest rates, you have revenue, you have expense, you have the credit quality of the tenant, and you have liquidity in the market, right? And when we look at retail from 5 years ago, retail struck out on all 5 of those items, right? Interest rates were high because they couldn't refinance. Nobody wanted retail, even though interest rates as a whole were low. For retail, you couldn't refinance your debt, right? Revenue was falling because of retail bankruptcies as early as 2016, right? That's when the Sports Authority went out of business. Expenses were high because you had a re-tenant. and reposition your building, credit quality was miserable, and liquidity was absent. Nobody wanted malls, right? You couldn't give them away in some cases, right? We were talking about making it stocking stuffers at the Clancy home, right? Right, in the office space, you do have higher rates, so you're 0 for 1 there. You may get decreased revenue as people renew for less space, and you do have higher expenses, but the credit quality is still there, right? We're not seeing credit issues, and liquidity is enormous. There's plentiful liquidity. So I think you have 3 strikes here, whereas you have 5 strikes in retail. And that's why when reporters call me and I said, it's not going to be like retail. And here's why. Give me your thoughts. What do you guys think about where we're going here? Is it apocalypse now or not?
I'm going to say it's not apocalyptic now, and it'll be remaining to be seen. What I mean by that is if the Fed goes hard, right? Say we have, 100 basis point increases and you see a slowdown, you'll see a recession. I think that might tip the balance in a way that's not a good way, obviously. If it happens quick and easy and we're back to, back to our regular programming by, say, October, you know what? I think you're right, Manus. I think we will have dodged maybe the worst of it.
I think it's interesting. The question is interesting. Office has really persevered better, I think, than any of us would have expected, given the onset of the pandemic and work from home and nobody being in the office. Even to this point, I think Castle Systems said this week a few of the cities got above 40% for the first time. But if you look at, to me, the stark difference is the willingness of tenants to pay the rent. So in retail, when a tenant is dependent on foot traffic or daily sales in order to cover their monthly rent, and they don't have that happen for a month or two, they, feel that impact immediately. And a lot of times these mom and pop retailers just close shop, and then the retail owner is left with a center that's not producing income. To this point, you have office tenants that aren't physically in the space or using it on a daily basis, but they're still paying the rent. And the leases are staggered, and there's enough tenants usually in an office building to give you a little bit of a hedge there. So I think all in all, like to your point, man, it's like not everything's in their favor, but a few of the more salient or I guess impactful things kind of have been in their favor. And if they can persevere for another 12, 18, 24 months and get on the other side of this, they're probably going to be poised for a really good ramp up. So that's kind of my take on it. I think it's interesting, every week we do the green shoots and we do the crabgrass, and it seems like office has been kind of heavy on both. So like we have a lot of green shoots every week, but then we also will have a couple of stories where you kind of shake your head and you're like, man, I'm not sure if this market's going to make it, So Chicago's been one of those where we've had several office stories that have just been really negative. St. Louis has been negative. We've had a couple of cities where, everything that's come out of there has not been great. So we did have one story this week kind of as a segue between green shoots and crabgrass on maybe a mixed green, which was, Kellogg's, they announced they're going to do a 3-way breakup, and it looks like Chicago is going to, maintain or have a larger office presence there through this. So their snacks division, which I think includes Pringles and Rice Krispies, it's about 80% of their net sales in 21. Chicago corporate headquarters, is going to stay located there. It looks like 412 North Wells Street, where Kellogg's is already officed. This comes on the heels of a couple of companies, Boeing and Caterpillar, recently announcing that they were going to move out of Chicago. So, they lost 2 really large, Fortune 500 type companies to relocations, but Kellogg's, even with this fairly large announcement of splitting their company up, is going to retain a pretty heavy footprint or presence there in the Chicago market.
So since we brought up Kellogg's, I got to throw it out there. What was it when you were kids? Was it Fruit Loops or Apple Jacks? What was the go-to guilty pleasure, or would your parents not let you have the sugared cereal? What was the vibe in your homes?
I was a post cereal child. I liked the Cocoa Pebbles. Guilty.
There you go. That's a guilty pleasure. How about you, Lonnie? What was your go-to?
Yeah, so was and potentially still is the Lucky Charms. to the point where my mom would like say, you can't just eat the marshmallows anymore. You have to eat some of the cereal. So I won't admit or deny if I still occasionally pluck some of those marshmallows out without any of the cereal.
So in the morning, Lonnie was, plucking the marshmallows. At night, he was twisting open the Oreos and getting the white stuff out, right? Was that what it was? That was your routine. How about you, Haley? You want to weigh in on this one?
Well, I was a weird kid and I only liked Rice Krispies and cornflakes. So
Oh, there's no
It
sugar in
was-
those. What's the matter with you?
I know, weird kid.
Well, we weren't allowed to do sugar. The cornflakes are way too limp for me, right? 5 minutes in the water, not even 5 seconds, and those things were like soup.
You gotta eat them fast.
You got to eat them fast. So I was mostly Rice Krispies and Cheerios, but if I had my way, it would have been corn pops all the time.
So
That was my
speaking of soggy cereals, we've got a couple crabgrass stories in the office space that we can jam through very quickly.
Yes, we really took a detour there. We don't do detours nearly as much as we used to. A couple of things down on the crabgrass side, and it goes back to, kind of finishing this thought, which comparing retail and office. In the retail time, the crabgrass was bankruptcies and mass store closings and huge vacancies. And a lot of our crabgrass lately has been, I would say, mild crabgrass, where it's a firm is not leaving, they're reducing their footprint by 25 or 40%. So it's not a complete disaster. Here, this one comes from Tim Schooley, another business journal veteran who does the Pittsburgh market extremely well. Emerson is looking to scale down. They're looking to possibly give up $270K at their existing location for $125K elsewhere. Tim Schooley says the Westinghouse complex in Cranberry is one of the locations that they are looking at. Another piece of crabgrass, we talked about this a few weeks ago, although I'm not sure we gave a number to it. Centene has flagged that they're looking to reduce their office space nationwide by 65%. That comes from James Drew of the St. Louis Business Journal. And in a great piece today, in fact, this was Thursday, in the New York Post, they have two writers that do a really terrific job covering the office market in New York. One is Lois Weiss and one is Steve Guozo. And today Lois came out with a really comprehensive piece on what the New York City office market looks like right now. And she really goes through a whole slew. I think it's about a dozen different properties that are either in the market, headed for the market, have recently traded and so forth. And I think that this is probably a primer for what people should expect in other markets. And I'll give two pieces of crabgrass here. She says the newest office to hit the market is 1360 6th Avenue, also known as Avenue of the Americas. It's around 54th Street. Blackstone and RXR are trying to sell that property. They have a targeted price of $350 million, or about $650 per square foot. The building was acquired back in 2010 for $400 million by RXR. They got it from Harry Macklow when he had his liquidity issues and lost the GM building as well. But here you have a situation where the property is going to be marked down by, 12% from where it was in 2010. And that is probably the new normal right now, right? Down 10% or 20% because of higher interest rates and sagging tenant demand right now. So that was one piece of crabgrass. In the same article, Lois brings up 450 Park, which is going to be sold to SL Green for $445 million. This compares to a price of almost $550 in 2014. So here you're seeing a drop in value of about 18% over the last 5 or 6 years. So when I give this not apocalyptic view, again, it's not pain-free, right? We're going to see these values drop 10 or 20%. And that's the case here in these two anecdotes in Midtown Manhattan. So a couple of crabgrassy things there.
Turning to multifamily, we saw a couple of interesting stories. One in the New York Times about rent stabilization. They're going to start seeing increases this fall for apartments that are rent stabilized.
Yeah, so let's give a little, insight on that. The Rent Guidelines Board voted 5-4 to raise rents on 1-year leases by 3.25% and on 2-year leases by 5%. Those may not seem like, really big numbers given the current rental environment on non-rent regulated or rent stabilized apartments. But for context, the last time the increases were this significant were a 4% increase on 1-year leases and a 7.75% increase on 2-year leases back in 2013 when Michael Bloomberg was mayor. The current increases are going to affect about 2 million New Yorkers. And then just for some additional context on the median income composition for the tenants, they have a rent stabilized median income of about 47,000 compared to about 63,000 for the market units. And then monthly rent for rent stabilized currently is about 1,400 per unit per month, compared to about 1,850 per unit per month in the market unit. So, this is a pretty big story. It impacts a large number of people, and by the rent guideline standards, pretty significant increase on a relative basis.
We also saw a story in the Wall Street Journal on vacant Wall Street offices that are going to be revived as apartments, and it's something we've talked about before. But apparently this is a rather significant conversion that we've seen.
Yeah, so it's interesting. This is a really ambitious plan. They're going to take 55 Broad Street in the financial district, and they plan to turn it into 571 apartments, market rate apartments. It's one of the largest conversions to be launched during the pandemic. It's a venture that includes Silverstein Properties and Metro Loft. They paid $180 million for the 30-story building that was opened in 1967. It's had, several technology and financial services office tenants over the decades. We've had some pretty deep discussions on this. There's been a lot of stuff put out in the marketplace about how difficult it is to convert office buildings to apartments. So I think this is one we'd like to keep an eye on and see how this plays out. It's a pretty big financial bet, almost $200 million in acquisition costs. As Manus mentioned earlier, that's just the starting point. They have to demolish all the existing stuff and then build out the new units. So this has got a pretty big price tag on it, but obviously they feel like it pencils if they can actually achieve, the conversion and start generating rents on the 571 apartment units.
Yeah, this is not unprecedented. I think it was 100 Wall Street several years ago, 15 years ago, where they were able to strip that and flip it from office to residential. But to your point, Lonnie, it's expensive. You're doing it at a time where if downtown demand for offices and financial services does not keep up, this could be a challenge, but certainly something to watch over the next couple of years.
And we have a deal of the week. Haley, please cue the drum roll.
We've become so technologically advanced. Remember, Joe used to do it by tapping on his keyboard. The advancements we make every day just boggle the mind. The story I wanted to touch upon here, and it's going to lead to a broader conversation on multifamily from Lonnie. Pacific Place Club Apartments sold recently to Nuveen for $69.7 million. Why did that capture my attention? Well, a couple of reasons. One was that the property last sold for $35.7 million in 2020. So we're up almost 100% in 2 years. And by the way, this property is in the Phoenix market. And the story comes from Paul Mariniak of Awatalkie.com. But we talk about, has this market reached a point of saturation in terms of price gains and appreciation and so forth? And even with rising rates and rising expenses, here we have a property having almost 100% increase in valuation over the last 2 years. But when looking at Paul Mariniak's piece this week, two pieces of data caught my attention as they were talking about this. And this data comes from Vista.com, which is a great job covering the multifamily market out west. But they said in May 2021, when they were marketing apartments there, 3/4 of the 1,500 leases that they closed in that marketplace during that time frame closed at asking price, and only a fraction came in below asking price. I think it was 19% came in below asking price. But last month, 41% came in below asking price. So we went from 19% below asking price a year ago to 41% now below asking price. So it begs the question, is this an inflection point? Have the owners of these properties gotten to a point where they've pushed the envelope almost as far as they can, and they're starting to see a point where they're going to start seeing leveling off of what they can ask? So with that, I'm going to open it to Lonnie because he has a lot of thoughts on where we are in this market.
Yeah, I think we've talked about it. We've put some material out. There's a lot of other people talking about this as well in terms of rent growth in the multifamily sector. Pretty much, across the U.S. I think it's not been limited to just the Sunbelt states that have seen significant rent growth. Multifamily has been pretty productive in generating increased revenue across the spectrum. I think part of my questions, come from with these really low cap rates and, property owners acquiring assets thinking they're going to increase rents 10, 12, 15, 20% upon acquisition, or acquiring properties that are midstream through renovation. So the current owner renovated 20 units, showed an uptick in rent, took it to market so that the new operator could see the full benefit of that. I think from a lender's perspective, this is kind of where I wanted to talk about this is, at what point do they start looking at potential risks as it pertains to the renters being able to pay the rent? It's one thing to sign a lease. It's one thing, we've seen this. Martha talked about it a couple of weeks ago. Credit card companies are seeing people pay late on their credit cards. Automobile lenders are starting to see people not make their car payment. And if you add up all of these rent increases that we've seen, your points, Bannis, are well taken. Like, they're having to offer a lot more concessions now, but maybe that's just the tip of the iceberg. What about these folks that stretched really far? They're maybe spending 50, 60% of their bring home pay on rent. Now inflation's kicked in. They have all these other costs that they weren't used to paying at such high prices, and they're not able to continue to pay the rent. So as a lender, we've talked a little bit about alternative data that people can use for underwriting or valuing assets or looking at, potential markers from the marketplace. I don't know if anyone's doing it at this point in the market, but it's almost of interest for the lender to say, what is the rent to income ratio for all of your tenants in your buildings? Because I think that would be a pretty quick way to identify kind of what the overall health of that income stream is on a relative basis for multifamily. So I know in single family housing, when you apply for a mortgage, they have certain guidelines on debt to income ratios and other things. And back when I used to manage apartments, it's kind of like your income had to be 3 times the rent. But we're at a point now where in a lot of major markets, people are literally paying 50+% of their income for rental. And I think there's some systemic risk there. I don't know what your guys' thoughts are.
I want to correct the record just before I get into that. But in 2021, 3-to-1 getting what they asked for versus having to discount, now 50-50. So I just wanted to clear the record up. So a real degradation in that. But to your point, Lonnie, I think that when it comes to the renter, right, they're getting thrown a lot of curveballs all at once. Higher energy, higher food, higher rents. And even though there has been wage growth and employment certainty to this point, there's a lot of evidence that wage growth has not been keeping up with expense growth. And I couldn't agree more with what you just said, that looking at that metric would be a great, and if anybody knows of this metric, if we can find it out there, we'd love to report on it, foretelling of potential credit issues in that multifamily segment.
Yeah, that'll be interesting to see how that plays out. If you saw a report that was released this week, the John Burns Real Estate